recorded.
I'm gonna come up asking for your permission to be recorded. Just say got it, as long as you're okay with that. If not, you can stay off camera. We'll give it another couple minutes.
Already. I'm excited for today. I'm excited. It's going to be a good one.
I think the
What
meeting
about
was
that?
confused. He's in my room. I'll click that.
Good job.
There you go.
That's athleticism. Oh, I don't know if it's supposed to be that big. Thomas said to keep it a certain size.
I think you can only control it on here, but that seems to be fitting. This TV doesn't.
How is the PowerPoint looking?
Looks fine to me.
Full screen, nothing's cut off. You can see everything.
Yeah, I see escaping public market. Yeah, I see it all.
Okay, awesome. Let's get started.
Yeah.
Perfect. Okay, we got a few more people in. They'll come in as they join. We'll let them in as they come. First off, we'll introduce ourselves. My name is Matthew Ford.
My name's Sergio Montano.
Either we invited you here today or you're wondering who we are and someone else invited you. No worries. We're glad to see you all here with us for the presentation. We'll be talking about private market investments and how to use that to escape the volatility of the private markets. As everyone has probably heard or seen firsthand, rates have been increasing this year, and pretty much since the beginning of 2022, the stock market and the bond market have not been looking very, very positively. If you had bought in maybe in 2020 or 2021 and just held, you definitely wouldn't be a happy camper today. But we have a bit of a solution for that. We ask you to come on video, join us, come off mute. Any questions you have, you don't have to wait to the end. Type it in the chat box, come off mute and ask us in person. We will be doing the presentation for about 45 minutes. At the end, we'll have a brief question period. So you'll be able to ask us anything that's on your mind then. Again, you don't have to wait till the end, but we'll focus on that. Then after that, you actually have an opportunity to go into a breakout room with the person who invited you to have a one-on-one conversation to see what you thought about the actual presentation and see if this type of investment is actually for you or not. With that being said, I'll go ahead and jump in.
Awesome. Thanks for that intro, Matt. So yeah, like we're looking at the title of the slide, and you know, it could be looked at as a little dramatic and you know, kind of like creating some hype around what's happening. But the truth is what Matt's saying is correct. We are seeing that both stock markets and bond markets have been coming down together, and that has destroyed trillions of dollars of wealth in, you know, public markets and some private markets as well. So okay,
You want to launch the poll? We're going to launch a quick poll. We're going to ask which of the following best describes you. Everyone here, some of you might have been invited and think, you know, how is this for me? I'm a stock trader. Some of you might be thinking, I don't invest a whole lot. I think we have some real estate agents here as well, who might be buying properties, but not in the market, or maybe haven't funded an RSP. So we're going to go ahead and launch a poll here. Just let us know if you're new to investing, you've invested before secondhand, like through a financial advisor. If you invest a lot on your own firsthand, and we'll get a gauge of what our audience is like.
and if you don't want to answer, you don't have to answer. It's okay, but we'll know who you are.
Is it not anonymous?
I don't know. We'll find out.
All right, we'll be anonymous for, I think, everyone on.
How much time are we going to give the poll?
I'll give it another few seconds to see if you coming in.
100% have answered.
Oh, okay, endable.
Okay, I'm going to share the results with you all. So yeah, most of the people here are new to investing, and if you're new to investing, this is a good place to be. We're going to give you guys some awareness, some education, to empower you to go out there. And whether it's with us or whether it's with someone else, hopefully it's going to be with us, to, you know, start taking your investments seriously.
Yeah, we got one person says, I've bought and sold my own assets in the past. And one person says I trade frequently and maintain my own portfolio. We'll see. Come on, ask us some questions. We'll figure out who it is, I'm sure. We don't know as of right now.
How do I get rid of
Dive
this?
into the next slide. I think it might be hidden at the top. Yeah, we'll X.
Oh, there it is. Okay.
That's what
All right, let's get into it. So what are we going to talk about today? We got into it a little bit. We're going to talk about the problem with the 60/40 portfolio. We're going to briefly discuss maybe why you haven't heard about the concepts of private market investments. And we're going to briefly talk about what they are. And then we're going to just summarize, and we're going to give you guys the pros and cons of, you know, traditional investments that many of you have probably already been accustomed to, versus or compared to some of these private market funds. All right.
Mhm. Okay, next slide. Perfect. So as Sergio already said, the 60/40 split is something that we've probably all heard about. And I'd say now it is outdated. It's been outdated for quite a while. This was something for the longest time that if you talk to a financial advisor or went to someone at the bank who is maybe even 30, 40 years old, they would have gotten their schooling and learned what to do in their job from someone who's been in the job for a little bit longer. And they were talking about what to do in a high interest rate scenario, maybe with rates increasing. And this doesn't always work. This idea was kind of that 60% of stocks would give you a good amount of long-term growth. And then the bonds would help with giving you some
Downside protection and income protection and income.
and downside protection, because they thought, you know, if the stocks aren't doing too well, at least you have the bonds.
Bonds will go up, or you'll have some income from the bonds. So it's, you know, it's kind of like the balanced portfolio, right? Balanced risk.
Mhm. Mhm. And if you're investing in paper assets with a bank, paper meaning at the end of the day is just something on paper, not a tangible asset. All they really have for the most part is stocks, equities, and fixed income, which is usually in the form of bonds. So they have two things to offer you. They just kind of split it up different ways. At the end of the day, it equals about 100%, unless you have cash or cash equivalents. And this is outdated. This is something that they should have been doing for a long time. And people started to really see during the notorious COVID-19 bottom.
And this is where people got to really, this is where you got to pay attention here. And this is an important part of what we're talking about. If you look at this chart, and what this chart is that's showing you the price of bonds, the yield of a bond. So how much you get paid if you own bonds. This is a chart going back 40 years. And what you can see is that this has been in a downtrend for the most part. So if yields are going down, the price of bonds are going up, right? So for the longest time, you had higher bond prices and you had higher stock prices. Okay, you had higher stock prices. So if you were just aggressively buying into equities and bonds month after month, year after year, and you stuck with it and you didn't sell and you stuck with your plan for 10, 20, 30 years, you probably made some money. And your capital has expanded. Now in 2020, what we saw was yields hit all-time lows on treasury bonds. Okay, so that means prices were at all-time highs. And what we've seen since then is the biggest reversal in interest rates on treasury bonds that we have seen since, you got to go back to like the 40s, the 50s. It's been a long time since we've seen this rate of change on the yields for government bonds, right? Now, this is the United States, but it's pretty much similar across the board. And you want to use United States as your benchmark anyways. Okay, are we going to pull up charts?
Pull up a chart. whenever you want.
Okay, I
If anyone
just-
wants to see,
Does anyone have questions about this so far? Any comments or concerns, or did something not make sense? This would be probably a good time to just, you know,
voice your concern.
orient, assess and see how you're all doing. And while you muster up the courage to speak, I will pull up a chart here.
And in case you're wondering, the reason Sergio said as the rates come down, the price of bonds go up. If you have a bond that was issued at, let's say like 4% interest rate, and now rates have gone down to 2%, people are willing to buy your bond for more than you actually paid for it, because you're no longer able to get a risk-free rate of return of 4% at that time. Obviously, the opposite happens when rates go up, and it's only exacerbated when it goes up so quickly by so much.
Right. So just to recap, this is the pandemic 2020, when the world was going to end. Okay. And this is when the Fed and central banks across the world put a lot of money into the economy. And it sent yields crashing down. And then the unwinding of all that, the extraction of all that money that was put out, resulted in this move up in yields. Okay. And it's this move up in yields that is the reason why your mortgage payments are higher, your credit card interest rate is higher, your line of credit interest rate went up, cars are now more expensive, and a bunch of other things are now more expensive. Okay. And the thing that you want to pay attention to is that we've potentially broken this 40-year trend of downward yields. So this could be an indication. And the reason why we know we broke it is because you can see that we've taken out previous highs of this trend. And we've come back into territory not seen since 2007, 2006. The last time yields have been this high has been 2006.
And this is a totally different trajectory.
Right.
Less economic easing. Say if you start getting into the investing world and saving and working at maybe 20 years old, this is a 40-year trend. So someone who's 60 would be able to say, I remember the last time this happened, this is what you should do. So no wonder people are getting the wrong advice everywhere they go.
Well, it's tough to say, right? Everyone's time horizon is different, and what they're in can alter based on that. But if you look at, this is the S&P 500, we're just going to look at this quickly because we want to make our point. Stocks, if you look at the S&P, so it's the United States, since the 50s, since the 80s, just steady. Okay. Now we're at a point in 2022 where we're near all-time highs. We're away from the averages. You know, to see this market come down to correct before it went higher over the next 5, 10, 15, 20 years, like it's not out of the question. It's not something that should surprise people if it does happen. Okay. So going back to our presentation, what we're talking to you all about today is you guys want to know that for the most traditionally styled portfolios are in a position to get wrecked if yields continue to go up. And you see how much that stock market can go down. If yields continue to go up, we stay in that uptrend, the stock market has a good chance of giving away all those gains. And that could set people back quite a bit, right? So we've seen the change of trend in interest rates. You know, we know how people have benefited in the equity markets since 1971. Here we have a chart of, do you guys know what happened in 1971?
Yep. Anyone come off mute? Type
No.
in the chat box why this is such a key year.
What happened in 1971?
Yep. So in the US, and every country's kind of followed suit, maybe at a different year, but around the same timeline. 1971, Richard Nixon decided to take the US dollar off of the gold standard and turn it into a fiat currency. And the only president after that,
Sorry.
turn that off. The only president after that attempted to reverse that in some way with silver was JFK, but he was assassinated before he could ever go ahead and do that. So ever since
Conspiracy theories.
1971, yeah, there's a whole lot of conspiracy theories that go down there. But has never been
So-
done. And now this chart right here shows,
But put simply, just to sum up what you said, Matt, pretty much what happened was money was not backed by gold anymore.
Hmm.
So your dollar was not backed by any tangible asset, where for years and years and years before, it had always been. Right? Since 1971, if I don't know if you've put two and two together, that's going back about 40 years. That is the length of the trend of the yields on the treasury bonds going down. So is it any coincidence that the same time that the gold standard was removed is the same time that downtrend of yields, so debt becoming cheaper, that downtrend of debt becoming cheaper, I forget what I was saying, but there's a correlation. There's a correlation there. And if that trend's changing, then maybe we're close to another 1971 type moment that could impact or alter the investment landscape that we've all been so comfortable, which is, blindly invest in an ETF portfolio, 60-40 stocks and bonds. And 20, 30 years, you're going to be able to retire comfortably. Maybe not. We don't know if the next 1971 moment is going to change the strategy or the effectiveness of that strategy.
yeah, this was a shot that was heard around the world, with US being a place where all other countries will invest, and every other country had either already done the same thing or did the same thing shortly after. So yeah, dollar is no longer a tangible asset. And speaking of tangible assets, that's exactly what we're going to dive into now.
Well, these are the type of assets that really benefited from this era of lower interest rates, right? If you were smart enough to take debt and buy assets and hold and hold and hold while these interest rates are going lower and lower and lower, then, you were doing well, right? And the people that weren't aware of that, those were the people that weren't buying tangible assets. They were probably maybe just saving or putting the money in GICs or, income bond portfolios, and they didn't benefit from that asset inflation as a result of trending lower yields.
Right. That's right. And then we'll speak about money leaving the equity market. It's not always clear if you look at the market cap of a lot of big stock markets, a lot of big companies, if it's all being held by smaller accounts and individuals, or if it's held by fewer people with a whole lot of money invested in those assets. That being said, on a institutional level, as well as very, very commonly individual level, when the rates go up, it is very easy for people to say, you know what, why would I say rates are around 4% for a 10-year treasury bill, which is probably accurate right now, around 4%. A lot of people who are in retirement might say, 10 years, that's kind of what I'm looking at. I'm already in retirement. In 10 years, I'd like to pull some money out. I want something very, very low in risk. I can park my money and get 4% a year, or I can gamble in the market, which is not making me feel really good right now. A lot of money will leave the equity market and go into bonds. And another thing to consider is that,
or annuities or fixed income type products. They have GICs now that are, I think BMO is offering a 10-year GIC.
there you go. Yeah.
5%, but you're in for 10 years.
Yeah.
Right. So as interest rates go up, like you're saying, you're going to see people leaving the equity market. The bond market has already collapsed. Actually, a lot of people don't know this. The bond market started collapsing before the equity market. Right. So you have the bond market going down for 3 to 6 months, and then the equity market followed. So now what you're seeing is the people finally realizing, saying, oh shit, interest rates are high, market's probably going down. Let me sell my stocks. Let me buy bonds. So you can see bonds actually going up now, the price of bonds going up and yields coming down, like we talked about in Wealth Wednesdays a few weeks ago. And you're going to see equities potentially to have further downside. And, I think the Fed just hiked 75 basis points 2 weeks ago. They're probably going to hike again in December. Bank of Canada is probably going to hike again. Then they're probably going to say, hey, like it's time to pivot. We might have to go to easy money. This is unaffordable for people. Everyone's going to think the stock market's going to go up. And that's probably the time when the stock market's actually going to crash. And then after that has been wiped out, then maybe the quantitative easing or the pivot that they do will actually take place, and then maybe we'll see the market come back up. But yeah, that's what we're seeing. We're seeing money leaving the equity market as a result of higher interest rates.
Yeah. And do you want to maybe expand on quantitative easing, quantitative tightening?
Yeah, like quantitative tightening. So when they're lowering interest rates, typically they're doing quantitative easing, which is a fancy word for saying creating money for the economy, creating money for government bonds. When that money's created, typically they want lower interest rates, so that money's cheaper. And the price of assets go up because money has just been introduced to the economy. That money then reprices the value of a bunch of assets.
Yep, you get that's a quick way to spike the economy. They did a whole lot of money printing and lowered rates dramatically during COVID. But then a byproduct of that is inflation, which I'm sure we don't have to tell everyone on this call about. You see that very, very clearly in everyday life.
Yeah.
This
This is why the inflation happens. So on the left here, I don't know if you guys can see this too well. I'll try to annotate.
Yeah, it's a little bit small.
It's small, but left is bonds, and then on the right is equities and stocks. Okay. So these are your bonds going up. The yields are going up. They're in an uptrend. As that's happening, the bond prices have already topped out and they've started their downtrend. Okay, so remember, there's bond prices and then there's the yield associated with the bond.
Yeah, it has almost an inverse relationship.
Exactly, inverse correlation. So if yields have bottomed, price has topped. So as yields had gone up, prices kept going down. Now you can see December 2021 right here. Yields were already on their way up. Okay, where on the equity side of things, December 2021, the equities were just topping out. Then as the yields continued to head higher, finally stocks caught up and started coming down. So like I was saying earlier, the bonds have been leading equities.
Yeah, giving a bit of an indicator.
Right.
As to what's going to happen,
Exactly.
even though it's usually ignored by most people.
Well, traders, money managers, they focus on bond yields more so than what the Fed is projecting or the overnight bank rate. They're looking at yields because yields typically tell a more truer story. Okay, so I just want to show you guys that correlation. So you got bonds on the left, equities on the right. Bonds actually starting their downtrend before equities, then equities finally following. And, you know, there's a good chance that the downtrend in equities can continue. Okay.
All right.
So let's just recap real quick. Can we recap real quick and then start the second half?
Yeah, go ahead.
Okay. So what's the issue? What's the problem? Stocks and bonds actually came down together. Okay. Accentuating, exacerbating losses for a lot of people that are in the 60-40 portfolio. Based on the change of trend in bonds and their yields, there's no real indication that yields are going to come back down and create that spike in equity prices. There's actually indication that the trend has changed. Okay, so the 60-40 portfolio may not be the best fit right now. Okay, and this is where, you know, private market investing can come into play. Now you can have equity, you can have aggressive style equity portfolios in the traditional market to avoid the bonds, but then you're still kind of going into the stock market, which we just showed you was far away from its average price. There's a lot of room for a reversion to the mean, so a reversion back to average price.
Yep, the moving average, we will actually look at
That's
that
right.
and point that out earlier, but put a pin in that.
And as yields go up, stock markets typically go down. And we just made the case for why yields may continue to go up. Okay, so this is where private market investing comes in. Okay, so we just give you guys the issue, the problem, being aware of the problem. You can go research that problem, dig deeper, get more information about that problem. Now we're going to give you a potential solution, not the solution. It's not the only way. It's you know, an alternative. Okay, and we want you guys and gals to be aware of the alternatives.
Yeah, and I'll say one last thing before we transition into the second half. I said money's leaving the stock market because the rates are higher. A lot of individuals view that as a safer way a safe place to put their money. But on the other side of it, you have large corporations that use a lot of debt. And the cost of that debt going up with interest rates going higher, they're realizing, okay, you know what? We're gonna kind of sit back, pay off some of this debt and stop leveraging so much. That stunts economic growth because it stunts entrepreneurship. So that's kind of what leads to a recession. Just that mentality of, okay, things are looking a little risky. Let's sit back. Things slow down. Ingenuity
Sell
kind of
stuff.
slows down.
Yeah. Okay, cool. So private market opportunities are typically open to accredited investors. Okay, so why haven't you heard about private market investing? Because it's typically not offered to just anybody. Okay, they have rules, they have criteria for what qualifies you as an accredited investor. Okay, so they want to see you and your spouse have significant financial assets. Okay, they're looking at your income, they're looking at what your assets are, your liquid assets. And the idea is that the private market is risky. So we only want people that investing in the private market that can afford to lose money in the private market. Okay. Now, the funny thing about this is I think they've realized how much of a sham this was, and they've done a pilot program to add another criteria for how you could qualify as an accredited investor.
Mhm.
And what that criteria is it's to show education. It's to show competence and knowledge in the financial world, the investments that are available to you. And you have to demonstrate that knowledge. And a lot of people are complaining. It's like, hey, we're the rich people have access to all these investments. They get to buy into things, they get to buy Twitter when it goes private. They get to buy Tesla before it goes public.
Mhm.
And those are typically not reserved for people like you and I. So they're changing the rules. You haven't heard about private market investing because it's typically reserved for accredited investors. The rules are changing, and you will be able to have access to these type of products. So, it's a good time for this webinar.
Yep, and we never break the rules. We read the rules, and if there's something we can do that's not against the rules, we do it.
That's right.
Yep. So how is this different from my traditional investments? The most part I'll say is it's not publicly traded for anyone and anyone to buy in and out. So there's a whole lot less trading going on there. And when we compare, we have a chart here. Unfortunately, this chart doesn't go up until today. This is a bit of a dated chart, but it does show what a tangible alternative portfolio compared to a traditional portfolio can do during times of
So what he's saying is
turmoil.
right. What he's saying is we're contrasting the difference in a private portfolio that has tangible assets, right? Alternative assets, private assets, versus a traditional portfolio, the S&P 500, the TSX.
Mhm.
And when you look at this chart, pretty much what these guys on these portfolio managers, what they're able to achieve, because they're mostly outside of these traditional assets, they're able to minimize the volatility when these big events happen, right? Like these big events like COVID, the Russian war, the oil crash, right? Like the China crash of 2018, like because of how they're structured, the investments they're in, the type of investments, the volatility is not there. Okay. So you have less volatility, you have more options for diversification, right? So what does that mean? More options for diversification. Private market funds have a little bit more flexibility in how they can invest. Okay. Traditional funds, mutual funds, ETFs, they have mandates that dictate what they can do and what they can't do.
Yeah, if a fund, someone has a CFA designation and they've put all the time and education and money into becoming a CFA and learning how to manage a portfolio, and then they go get a job at Scotiabank or TD Bank, and they're working on a portfolio that is for, let's say, pick a sector. I don't know, maybe real estate,
Just financial sector.
financial sector, and they see an amazing opportunity in a different sector to make their investors earn a lot of money with low downside. They won't be able to take it if it's not inside of the financial sector, because the bank says, hey, this fund is designated for the financial sector. That's what you're supposed to do. That's the mandate.
And their
That's what
mandate
you're
is to
charged
buy.
with.
Their mandate isn't to sell. Their mandate isn't to short, to get rid of the mandate is to buy. We're gonna buy and we're gonna buy and we're gonna buy. And if the market goes down, we're gonna buy, we're gonna buy. It's right. They don't change their strategy. It's you have this type of fund. This is the mandate. It's in the prospectus. That's why they give you a prospectus. And believe it or not, that's what makes traditional funds safer. Okay.
Yep. And one other thing,
Tell us,
has
Matt.
anyone ever been turned down for a mutual fund or an ETF? I've never heard of that.
No.
A private market fund can find an opportunity, capture that opportunity, maybe they sit on the board of directors with companies, and then that opportunity means they need to get some capital. They'll raise capital, let you invest, and then they'll shut it off for a little bit because it's getting too much money inside of it. And that's
Yeah, they're not looking to get $100 billion in their fund.
Yeah.
Right?
More is
The
not
deals
allowed.
don't allow for that.
Mhm.
But the wealthy have known, so they made it so you couldn't invest in private market funds or private equity. And then we go and see that these private market funds and private equity funds are actually outperforming everything that you're invested in. Right? So outperforming the S&P 500. Yes, it is. And if you're in the S&P 500 and you're in these bond portfolios, private equity is even crushing you even more. Okay, this is a comparison between private equity and the S&P. Private has outperformed. It will likely continue to outperform. Doesn't mean there won't be crashes or headlines of private equity companies going bankrupt, etc. That will come, that will happen. A lot of over leveraged for sure. A lot of them getting caught with these higher interest rates for sure. But overall, private market funds are outperforming public market funds.
And it's a very broad term. I mean, what private market fund? You know what I mean? I'm sure we've all.
Private equity index.
I've looked at private investments that are not the same as others.
Correct.
Just like you look in the public market and it's not the same. Someone might have a low cost ETF for you, or you might buy a penny stock and it goes to zero. Like there's a whole world of it in the public side. There's a whole world of it in the private side, but it's much less talked about.
Yeah.
But even the CPP, Canada Pension Plan, which I'm sure everyone here has money in, they haven't looked into private investing because their specific reason for it was they were in a bit of a 60-40 split, and they realized earlier than a lot of financial advisors did back in 2005, you know what, this isn't going to work if the rates keep going down, because although the bond prices go higher, we're holding bonds that aren't paying a whole lot. Interest rates are really low.
Well, as
A lot of liquidity
yields were
coming
going
in.
low, as yields were lowering, they're deleveraging, they're downsizing their position. Right? You can see in 2005, their fixed income position was 35%. Right? So remember, yields are higher in 2005, right? Yields are high. Then in 2010, yields are lower. Right? Now they're reducing their position 27%. 2015, yields are even lower, so they're reducing their position. Then 2020, they're at their lowest. And as well, they should be at their lowest because that's when that was the top for the bond market. And it's crashed since then.
Yeah, bond prices went up. They're probably selling bonds.
That's
And
right.
they have to pay out pensioners as well. And I can see real estate took a big percentage. And you have private credit and private equity. Private credit market is wild, I'll say. But when it comes to real estate, when it comes to insurance companies own some of the best pieces of real estate ever. That's not a coincidence. And when it comes to investing in their,
Manulife just retired their whole real estate arm.
they did.
Yeah.
Wow. Okay, I'll have to dive into that.
There's like 60 employees. They just done.
It's crazy.
It's done. So we'll see if that changes. Well, probably next year we'll see the real estate. Who knows if the real estate portfolio, I think they're gonna downsize it.
Yeah.
So this chart here is showing you just how correlated public market funds are. So before, what you would do is you'd say, okay, I want diversification in the investment space. I'm going to buy a little bit of North America, a little bit of South America, some Europe, some Asia. Well, you probably buy a lot of America and then buy a little bit of those other ones. But now what's happening is over time that those stock markets are kind of just moving in the same direction. So you're not really getting that diversification that you once did, you know. And that's not good because it pretty much means you got nowhere to hide.
We
Okay.
saw that in cryptocurrency a whole lot. We looked into that, and although they are all different, they're all run completely differently. They move almost together. You could take charts of them side by side, and for the most part, they kind of follow the same trends up and down.
Yeah.
And
Of the
that's
stock market.
what you see in the stock market, very similar to crypto.
Right. So just to clarify, because I don't know if we made it clear. Private market funds, you're investing in assets that are not publicly traded. So you're investing in private companies that are not on publicly traded exchanges. Okay, now that could be an advantage or that could be a disadvantage. Right? That's an advantage in the sense that you could potentially be investing in a company that's in its early stage and has the potential to go public. And then now your investment has, you know, multiplied significantly. And it's also a disadvantage in the sense that it's private. So there's less disclosure, there's less transparency, there's less information. Right. And I think that's the main thing. It's like when you're investing in your mutual fund at TD or CIBC or whoever, you know, those investments are in publicly traded companies and publicly traded government bonds or provincial bonds or whatever. When people are investing in private market funds, you're not investing in companies or in stocks of that magnitude.
Yep.
Right. So people need to know that, like, you're investing in smaller companies, early stages typically, or medium stages. And, you know, you're maybe getting in on a deal where you're lending them some money. There's interest payments on that. And then you have maybe the opportunity to convert to equity. And now you can have some ownership of that company. And if they go public, you can make a bunch of money. And if they don't do so well, at least you have claim to their assets and you can take their assets and recoup some of your investment. Right. So, you know, the investments in the private market funds, they're not to say that a hedge fund, which isn't the private market, like they do have access to the stock market, but predominantly a lot of these private market funds are doing smaller deals, smaller companies, medium-sized companies, and they're really boots on the ground, right?
Yeah. And
Type of investing.
you said something key about going public. Me and Sergio have looked and analyzed some of the charts of companies when they go public, right when they IPO. And what would you say usually happens? It depends on the company, but
they mostly go down. It's
yeah.
typically like when a company's IPO'd, like, you know, people are cashing out. People that are invested in the private market are using the public market to cash out.
Yeah, I'm trying to think of an example.
I think people need to know that.
That Beyond Meat company.
Yeah.
That was the talk of the town. They're going public. There was Rivian,
Right.
the electric car
Yes,
company.
yes.
There's usually a good pump up because people were like, hey, the forbidden fruit, I couldn't have that. Now I can.
It's the
wanna
hype,
buy
it's the
in.
excitement, but that's people exiting. That's exit liquidity. That's
Yes.
what it's called. It's called exit liquidity. You can Google that term. There you go, free of charge. It's gonna change your life. Don't be someone else's exit liquidity.
Yeah.
Okay.
So you can either be on the public side, buying into that company. You know, a lot of them will have that pump and then they'll come crashing down. And or you could be in the private market and selling off that opportunity to someone else. And they don't all go down. I'm not saying that that's always what happens. But there are pros and cons to both. When it comes to diversification, there's always been this conglomerate of funds and companies that weren't in the limelight. You couldn't just go on Google and look up their stock ticker, kind of hushed away. And yeah, that's all I'll say about that. Kind of the forbidden fruit.
Cool. Very cool. So we just want to summarize this pros and cons, right? You know, we're not saying private market is end all be all. But definitely it has its pros and definitely it has its cons, and same with public market type funds like your mutual funds and your ETFs.
Yeah, we'll talk about the cons. The big one is accredited investors have always been a bit of a sticking point, and this is in the rules. This is in
OSC rules, yeah.
This is in the rules from the OSC. But a lot of companies might say, you know what, we don't want someone investing their last dollars and then coming looking for it. And a lot of these private market investments are not liquid. They want to lock up. So if they can't lock up, they want to make sure you have a good amount of assets, a high net worth, so that you're not coming to them to take that money out at a bad time. That's just kind of the,
And it's just the way their
Downside
deals are
protection.
structured, right? Like you can sell a stock or a government bond in the blink of an eye. But to sell your convertible debt with private XYZ company, you can't just do that so easily. Right? So when you're investing in these type of funds, you want to know that going in, you want to know that you're going to typically be in for a term. And if you want to access your capital, you're probably going to have to wait 30 days. It's not going to be like a few business days. And you might not get the type of disclosures that you're used to, like if you were investing in a mutual fund.
Yep.
Okay. And then let's talk about cons in the public market real quick. We know what it is. It's that high volatility, right? It's the big fluctuations in your account values. I've seen it this year, especially doing my own stuff. You're investing for 10 years, you're not seeing the returns, right? I know a lot of people in that camp. If you're investing in bonds, like bond prices are back to where they were in they've gone back like years, like decades.
yeah.
So in a very short period of time, like the value of these bonds just collapsed, and I don't think people are aware.
And if you own the bond directly, you'll have income that you pay income tax on capital gains tax.
It is income tax, of course.
Yeah.
Yeah.
But if you're holding it in a mutual fund, you don't usually collect from that mutual fund. That mutual fund is worth what it is.
Correct.
And so people that are looking at their portfolio of bonds, and it's the same as it was, how long you said, 7 years?
More than that.
More than 7 years ago.
The yield, but the price, the yield is like not since 2007. And the price is back at like, I don't know, I think it was like 1990.
Okay, so you're
So
talking.
back like 30 years. So who knows, maybe bonds are going to skyrocket from here. But anyways, guys, we are about to wrap up. We covered quite a bit, right? I hope you saw the point that we were making with the 60-40 portfolio, the vulnerabilities of these traditional funds that most people are in. We kind of created or opened your eyes to the private market, gave you some very, overview, kind of vague information, but you kind of get the picture. Now we can dive in, we can talk about it more, you can do some more research. You can check out that pilot program that we were discussing. I think it's cool that they're doing that. I think that's, people were complaining, saying, why aren't we getting the equity? Why aren't we getting access to, what the wealth you're getting access to, right? And I think it's a fair point. Do you have any last words, Matt, or you want to leave us?
Also,
leave the people
we
with?
made it clear about the accredited investor designation. It has a few definitions. We showed two: net worth and income are usually what's used. That being said, if you know the manager of a portfolio, assuming it is an actual portfolio, not
There's ways around the rules.
company,
There's ways around those rules.
if you have an introduction with them and you are friends or family, that is waived. You don't have to qualify for the traditional definitions of an accredited investor.
Right. So if you stayed to the end, that was the kind of surprise. It is open to you. You might have thought you didn't qualify. You probably do qualify. Have a conversation with whoever invited you here today. And if you have any questions, now's a good time. I think we finished right at 6:45, which I appreciate. Like, look, for myself, that makes me happy. I don't really know how you guys feel about that. It makes me happy. It's orchestrated well.
Yep.
And now we can have 15 minutes of questions. If there's that many questions, doesn't look like there is. But I'll stick around here.
Yep, feel free to come on with any questions, and we'll have the opportunity for you to jump into a breakout room with the person who invited you. If you're not familiar with Zoom, you will be able to go into a separate room
Or just call
with a
him.
private.
If you can't figure it out, call the person.
Yeah, but it'll be pretty simple. I'll open the rooms and have their names on it. So if they're from our team, it'll be their name. You can go ahead and join there. They'll be whisked away into a separate meeting room. So you can discuss in private. No need to come back here to the main room when you're done. And thank you for joining us, and have a great night.
Have a good one, everybody.
Awesome. We'll open up the rooms here. So just give me one moment. And honestly, any questions, feel free. Nothing, no such thing as a wrong question. Go ahead, jump on, ask us whatever you want to ask.
There's no questions. No concerns, no thoughts. Share about, okay, you don't have questions. Share your thoughts. What's on your mind?
Yeah, comments. Sure.
People don't want to share what's on your mind at least.
Another moment with the room.
Is there any way that you guys can project if and when interest rates may or may not come down? I know that's
Yeah,
like
like,
a
here, let's-
question, but
Sorry. Can you repeat your question?
any way that you guys can project if and when interest rates may like go down? I know that probably not, but I mean, the fact that they are so high, it's a fair question to ask as a civilian, I guess.
Yeah, I would say look at this chart. So I'm pulling up the chart of the 10-year US government bonds. Right, so I think the way we know if yields are gonna, or interest rates are gonna come back down
Mhm.
is if, for me, we start getting back into this downtrend. How do we know we're in this downtrend? We're back below this moving average. See this black line?
Right.
That's an average calculation. So if the average price gets back below there and it stays there for like, a few months, then it's a good indicator that we're going to continue to head lower. If we stay above that moving average, then that's an indication that we're going to stay, head higher.
Mhm.
Right? So in the short term, so thinking short term now, which, maybe isn't the best thing to do. In the short term, we could probably get like the yields coming down a little bit, right? Because they've gone up so far so fast. And then that's the moment of truth. Then we got to see, okay, are the yields going to hold?
Is it going to stay steady or fluctuate again?
Or are they going to collapse? And we got to pay attention. So that's what I'm looking at. So it's too early to tell. I'd research Japan. I'd research what happened in Japan in the 1990s. And then, let that inform you a little bit. But I don't know is your answer. And I'm looking at certain things to try to be informed.
Yeah, no, I figured there's no direct answer. I just thought I'd pose a question.
Yeah, no, thank you for the question. It's an awesome question.
Yep, we gotta be ready for either scenario. And instead of just Googling what happened in Japan in 1990, maybe we'll elaborate a little bit more.
I don't think we should, man. It's too much to elaborate on right
Okay.
now. I don't think they can handle that much right now. We got 10 minutes.
Okay, got that. So I'm gonna open the rooms here. That was heavy, okay. I'm gonna open the rooms here with everyone's names. And whenever you get a chance, go ahead, you can just assign to yourself,
Is
so
there any more
all of
questions
our
though?
team members. Does anyone else have any questions before we go ahead and do that? Any
Is there anything in
commentary,
the chat or anything?
anything at all? I don't think anything in the chat, no.
Okay.
Nothing in the chat. So each of our team members has their own room listed. So whoever invited you, go ahead and click that. If you're not sure who invited you, just stay here with us. We'll try to figure it out, but you should know who it was. So I'm going to jump into my room. And thanks for joining us. Feel free to reach out to Sergio and myself via email. Ask any questions that you have at all about rates or future kind of our predictions. Sergio's had quite a good track record on predictions, and
I know, but why aren't I bloody rich? Why aren't I like bloody wealthy?
you actioning your predictions?
There's too many actions to be taken.
Oh, excuses.
Is everyone in their breakout
Excuses.
rooms?
I'm gonna hop in mine now.
Okay, what do I do?
Just
Sergio, you have time for one question? I don't,
Yeah, please. I don't know if other people can hear your question. I don't know what's going on.
That's right. Demetrios is in his room with Penny and Phil, so they're doing their thing. Everyone else is here with us still. So Randy, what's going on, man?
yeah, I was just kind of curious of what your thoughts were like on China and Russia and what they're kind of up to and how that's going to play a bit of a factor potentially in the stock market. Any
China
thoughts on that? I know you guys
Are you referring to BRICS or what are you referring to?
yeah, referring to BRICS.
Yeah, it might be RICS now instead of BRICS. I don't think Brazil's going to go through with that. Seeing as if I think it's Lufa. I'm not sure the pronunciation of his name, but I'm sure if he gets in, he will pull them out of that sort of alliance. Yeah, what are your thoughts on BRICS or BRICS now?
That's a,
Seems to be at its infancy.
like, I'm not I don't know, like, it's a tough question, right? Like the biggest threat is to the reserve status of the US dollar.
Mhm.
Okay, so if there's a threat to that, could it have an impact on the North American stock market? Absolutely. In this presentation, I showed you the stock market going all the way back to the 1950s, and this thing has just gone straight up. Okay. That hasn't happened in many other stock markets. Okay. Like if you look at other stock markets, I don't know if we'll get into them right now.
Pull up the Nikkei real quick.
Okay. Like if we look at, let's look at Japan.
Yeah.
What's the Nikkei? Yeah. Right. Like this is the Japanese stock market. Okay. So Randy's question is what happens if China and Russia come together? And I don't even know about China and Russia. Okay. But like, he's asking, what if China and Russia come together and do something to disrupt, I guess, the geopolitical landscape that we've known our whole lives? Okay. Well, the US dollar could lose its potential reserve status. That could impact the economy. I don't know. Maybe it wouldn't. I don't know. Maybe it does. I don't know. Like maybe it could be good for the economy. That's the thing. I don't know. But assuming Saudi Arabia and other countries were able to sell their commodities in currencies other than the US dollar, you could see the US dollar come down, and you could see the stock market after a crazy move up. So here's Japan since the 1950s. Okay. Market goes straight up from 1950 to 1989. Okay. So that's a steep uptrend. And, you know, they printed tons of money during this period, right? Kind of what we did during COVID. Everything went up. Their stock market went up like crazy. Real estate went up like crazy. And then they topped out in 1990, and they were in this downtrend, a downtrend for 32 years, give or take. And then the uptrend has finally started, and they're still not even back beyond their 1990 prices, right? So the Japanese stock market has not made a new high. Okay. Now, I don't want this presentation to be about, oh, that's going to happen in North America. It's going to happen in the US. It's going to happen in Canada. But it could happen. Right? So look at the US dollar, look to see if that's going to strengthen, and pay attention to any news that could threaten the current US dollar hegemony that they have over the world.
Mhm. Would you think that there might be opportunities coming across our way because of that, if that potentially comes to fruition? Because I know it's not literally happening, is it?
I don't know if that's happening yet. It could be in the early stages, right? Like if you look at the US dollar here, pulling up a chart of the US dollar, you know, we were back to levels not seen since the year 2000 in terms of the US dollar. So that means the US dollar has been on its uptrend, okay? On an uptrend since 2008. Okay? We've hit a high, it looks like. It could be the start of a move down. And then you could see news develop reinforcing that narrative that the US dollar could be losing its credibility or its, you know, grip over the world.
Mhm.
Right? But you'll see it in the price before we see it in the narratives. That's for sure. The price of things before we see it in the narrative. That's a good question, Randy. I don't know. I don't know too much. Like that, you want to Google, do some more research. Those are my thoughts. I don't know too much.
I'll say Russia. I'm not 100% sure about China, but I know Russia did not turn on their paper printers as much as we did for their money over the last couple of years. But now their currency took a hit once the war started. They kind of got boycotted. I don't know if the same sort of thing is going to happen to China. Like dictatorship, sometimes one gets boycotted, the other one doesn't. They're both doing, you know,
I don't know.
bad things. That being said, our currency is constantly being inflated, and that inflation amount does compound. I don't know what Russia's currency is going to look like. Last time I looked at the Russian ruble was,
No one wants the
Many,
Russian,
many
you don't want
months
to buy
ago.
the Russian currency, okay? It's not,
I'm not saying.
this
it's-
is something, stay away from that. You don't, Russians are trying their hardest to get rid of their Russian currency, okay? So no one here is trying to buy Russian currency. They want to get rid of the Russian, maybe they're trying to buy Bitcoin. They're trying to get their hands on Bitcoin, they can't.
Is Bitcoin banned in Russia? I know
Yeah,
it's
you
in
can't buy it, you need to
Okay.
buy it on the street,
On this-
and that shows you how valuable it is. If you're buying it on the street, it's in demand, people want it. And that's the truth.
Okay. Any other questions? Anything else from you, Randy?
No, thanks. I appreciate those thoughts, and yeah, really good. Thank you.
Perfect, perfect. Okay, go ahead and click on the room with the name of the person who invited you. And if that's all, we'll see you later. We will have other topics coming up. You'll probably hear about them. If you were invited today to this specific topic,
You're gonna
that
get invited to
means-
the next one.
probably,
Oh,
it
sorry,
means the
well.
person who invited you thinks you benefit from this conversation. Other topics we dive into might fit for you, might not fit for you, but keep your ear to the ground and see what comes your way.
Awesome.
Awesome.
Bye,
Have a good
everybody.
night.
All right, bye-bye.